As we go through the presentation today, what we're going to do is we're going to be talking about the cash flow model first. And so here's what I mean by the cash flow model, the basic fundamentals of real estate investing. That's what we're going to hit on. And we're going to hit on that first because we need to, as we're talking about market timing and all this, we need to know where we are from a fundamental standpoint before we go into some of the more complex things about market timing. What's very, very important is that you don't get off of the cash flow model. So I drill that in all the time, but particularly on this presentation, because you need to know, what the underlying fundamentals are of any property before you start looking at a little bit more of the complex strategy of market timing. All right, we're gonna get going with the presentation. Now, there's a book that I'm basing this work on, and it's called Timing the Real Estate Market by Craig Hall. It's an excellent book. I really advise everyone who is really wanting to be serious about real estate investing to get this book, Timing the Real Estate Market, because it goes from the author, Craig Hall, kind of looks at his career from when he started in the 60s all the way up to the 90s. The good, the bad, the ugly. A lot of times people, when they write books, they're only telling you success stories. They're only telling you, the highlights, if you will. Craig Hall gets real in the book, and it talks about some of the successes he had and a lot of the failures that he had, and how that related particularly to timing. And he is really, really big into this. And you'll see as you read through the book how that applies to what you're doing in your real estate business. And that being the case, in March, about to be April 2021, I think there's all kind of segmented parts of our market: single family home market, commercial, within commercial, multifamily homes, multifamily properties, retail, office, industrial. Everything's a little bit different right now. So I really think that you want to understand this whole timing piece and how that relates to your plan. Now, that being the case, who am I? A lot of you guys know me, a lot of you won't. My name is Steve Peterson. I'm the broker and owner of Infinity Investments. We're a commercial real estate firm that I started in November 2009. We specialize in the sales and acquisition of apartment buildings. We do other commercial real estate as well, office, retail, but apartment buildings, multifamily properties are our sweet spot. And I'll kind of share with you as to why that is. Now, you can use this information for any type of property, but we really love multifamily. And even now while we're in an eviction moratorium, even now while we're just in a very difficult time in terms of leasing up properties here in the Oakland, San Francisco areas, still is the best food group of commercial real estate because there's stable cash flow during the holding period, the time you own it. There's high occupancy rates historically and currently. Financing is available at more attractive rates than they would be on office, retail, hospitality, typically. There's more economies of scale than you would have if you own a bunch of individual single family homes. So if you got a 10-unit building, 2 people move out, you still got 8 units that are producing rent. If you got one house, that person's 100% occupied, but they move out, you got 100% vacancy. While you're turning that unit, while you're getting that home ready for rent. So that's part of the economies of scale that you really get with multifamily properties. And I think it's a lot easier to lease up, all things considered, apartments than it is retail properties, office properties, and other commercial real estate. So it really is a unique space, and that's why it's been so popular over the last few years. Now, it's an excellent generator and preserver of wealth. Here's what I mean by that. If you're just getting going in your career and you're just ramping up, you want to be able to have a method and means to be able to generate wealth at an accelerated pace. I believe apartments allow you to do that from a growth scale better than single family homes. And I think you, especially starting out, you can afford to make more, mistakes on multifamily properties than you can on office, retail, and other types. So that's what I mean, and it's an excellent generator of wealth. But you've got a lot of capital and you're just trying to preserve it and grow it. down the line, but preservation is first and foremost. This is a great place to put it because you know, even if the economy it's a snag, typically you're not going to see huge drops in values. And if you do, like we did in the Great Recession, even when values drop a lot, the rents never really drop more than about 10%. Now, the rents have dropped in San Francisco and they have dropped in Oakland anywhere 10 to 15% here recently. They were really overinflated, you know. So I take that with a grain of salt because the rents got out of control here in the Bay. And that's definitely something that you want to, you know, when you're analyzing markets, you're analyzing buildings, looking, you know, don't, when you're putting pro forma rents together, market rents, you know, don't go wildly aggressive at that point. A lot of developers have done that, basing their developments on, you know, 20% rent growth. So when they start their project, they're expecting rents to grow 10, 20% like they have been. So when they're done in 3 years, they're expecting that. And that could cause some issues if you're expecting that and you get there. But anyway, this is just the reason why we like multifamily properties. I won't go on more with that, even during this period of time. Now, I know a lot of people selling apartments, getting a triple net, other type of commercial. Can't blame you there. That's a great strategy, but I still think multifamily is the best. Now, within anything, like I told you guys, we're going to blast through the cash flow model at the first part of this presentation. And then what we will do is come and wrap it up talking about market timing. We got to hit the blocking and tackling first. So this is the key indicators that we look at when we're evaluating a property. That's going to be cash flow number one. NOI details is net operating income and the details surrounding that. Also the price and cap rate, the return on investment and return on equity, along with the cash on cash return, internal rate of return, and market cycle position. Where are you at in the market? Those are some of the key indicators we're looking at when we're evaluating properties, people's portfolios, and trying to figure out what is our next step. And you want to have these as a guiding principle. That's why I'm drilling this in. Okay, so the cash flow model starts with the analysis of the income that's coming in on the property. In order to do that, we look at the gross scheduled rents from a building, which is going to be derived from that building's rent roll. It's going to show us the current tenants, how much they're paying, and it's going to show market rent for any vacant units. So that's where we start. We start there at the gross scheduled rents, and then we begin taking away. We take away from that vacancy. We take away from that loss to lease concessions. And then we add to that, if there is in the building, other income. And other income is simply any other income that's generated that's not rental income. So this could be billboard, this could be laundry, this could be vending, this could be cable contracts on larger buildings. It's just any other income that the building generates that's not rental. And you want to look for ways, if you're evaluating a building and there is not that, you want to look for ways to generate other income. And if you got as small as a 4-unit building, you got to be looking at laundry as a real way of bringing in other income. And it's not, it's a little bit of income, but what it really is an amenity to your tenant. Very, very important. And so the bottom line number of income is the effective gross income. So that's effectively what you're collecting and or what you expect to collect. Let me just say this though, when we're evaluating properties, we need to look and evaluate the past in order to be able to develop a clear picture for the future. So when we're doing our projection, our pro forma, we're basing that on the history of the past. We want to look at the last 2 to 3 years of the actual profit and loss statements from that building. Analyze that, look at the current rent roll, and then create our pro forma going forward. I just want to make sure I drill that in, because a lot of you, especially if you're just getting going, you look at the marketing package from someone, from a broker, and you'll see the pro forma. And you got to understand, if we're going to create our own pro forma, we need to look at the actual P&Ls and the actual rent roll in order to create our pro forma. Let's not look at the other brokers' pro forma to do ours. Very important. All right. Once you've got the effective gross income number, now we got to start chipping away off of that with what we call operating expenses. Now, pay attention to this, operating expenses. It is not including your mortgage payment. All right. It is the cost of doing business, the cost to operate the building. So if you paid cash for a building, you're still going to have these expenses. And this is TIMR is an acronym for the most common expenses that you'll see. Taxes. These are now property taxes and also like Personal property taxes. In Oakland, we got like City of Oakland business taxes. Taxes, you're gonna have to pay them. Insurance, management, off and on site. You got 16 units or more in the state of California, you got to have an on-site manager. On top of, if you have a property management company, that's what's called off-site management, right? Maintenance, preventative and emergency. Do more preventative maintenance that'll minimize the emergency maintenance. Utilities, repairs, reserves, just to name a few. Some of the other expenses that you might expect to pay are things like landscaping, things like pest control, security on a larger building, just to name a few. So these are the cost of doing business. Again, you're going to identify what you're going to project for the future based on what you have from the past. So you got to analyze those last 2-3 years of profit and loss statement. And as we start to talk about market timing, the profit and loss statements, the numbers, they tell you a story about the building. And you can start seeing, like, for instance, if the building has excessive maintenance costs, that like maintenance costs that are over about 10 to 15% of the building's income, you know that building's probably got a lot of deferred maintenance, and or they're overspending on maintenance. So if they're overspending on maintenance, then you look at it and you know, hey, this building's in pretty great shape, or at least you can have that assumption. So drill into these numbers, looking at the past in order to project for the future, because now that's going to get you to the all important line item of net operating income. And essentially, the net operating income is the net income after accounting for all income sources minus all non-debt expenses. Debt expenses are going to be your mortgage, and what we call in commercial real estate is debt service. That's your mortgage payments. It's the fancy word of saying mortgage payments. So net NOI does not include payouts for mortgage payments. In fact, you make your mortgage payments with the net operating income of a property. Pay the expenses first. What's netted is really the lifeblood of the business, because you take that, pay your mortgage, pay yourself. If you don't have a mortgage, you take that, all of that net operating income is the property's yield. That's what you get returned to off the building. Very, very important. And essentially, it's what's left after you collect the rents, pay your bills, but before you pay your mortgage. It's what you pay your mortgage with. Now, it's also what we use to valuate the property. We have to capitalize the net operating income in order to come up with the value. And to do that, we apply the capitalization rate. Capitalization rate is the rate of return generated by a real estate investment property based on the annual net operating income that a property generates. Basically, represents the percentage return you would get from a building if you paid cash and didn't have a mortgage. The first definition is the Webster's definition. The second one is the feet to the street definition. You know, bottom line, this cap rate is the rate of return that the building generates on an annual basis. All right. If I pay cash for a building, and that building's net operating income is going to be the yield. And so that is what the building is yielding. All right. And the formula for this, cap rate equals NOI divided by purchase price / value. Okay. Meaning that if I'm doing an analysis on a property, I would, versus like buying it, I would substitute purchase price for value. If you're doing a refinance, same thing. All right. Here's the deal about this. A little bit of algebra on y'all. If you have two of these numbers, you can solve for the third. So if you got cap rate, you got NOI, you can solve for purchase price. You know, you got cap rate, purchase price, you can solve for NOI. If you got NOI and purchase price or value, you can solve for cap rate. So as long as you have two of these factors, you can solve for the third. Now, I did see someone in the crowd has raised their hand. What I'm going to do is I'm going to go through the presentation, and then the last 5 to 10 minutes, I will leave for questions. And I'm doing that just so that we can get through the presentation in a timely fashion, as I am, cognizant and aware of your time. So I will come back to your question at about 1:50. But hold that note. If you want to put it in the chat so you don't forget, go ahead. But the cap rate principle is very, very important when we're talking about evaluating property, but it's really important because that is the measure of what the property is worth. Now, we're talking about market timing today. Cap rates are going to change. They're going to fluctuate within market pressures. Now, what's weird, I won't say what's weird, what's interesting about today in commercial real estate Market's a little bit softer than it was year and a half, 2 years ago. A lot softer. It was rolling. Okay, it has not crashed, it's not dropped off a cliff. There are still transactions being done, albeit a lot less than it was pre-pandemic. Here's the deal though. Cap rates have not gone up. And the thing about a cap rate, as the rate goes up, the value goes down. As the rate goes down, values go up. So cap rates have not gone up in this marketplace in general. If anything, I was talking to an appraiser yesterday, who called me about a building that they're doing, and I had sold some buildings in the neighborhoods. We were having a real good conversation. And he said to me, he said, you know what's interesting, Steve, is that, yeah, we are seeing a little bit of a slow up. We're not seeing a big drop in prices, but I'm actually seeing cap rate compression, meaning cap rates are getting lower. Big part of that, as he says, has to do with the treasury rate, the interest rates of the world, if you will. Those are pretty low right now. And so that's what's keeping cap rates very low as well. However, investors are pricing in risk in the market. So I think that's why we're not seeing as many transactions, because investors are saying, well, look, there's still a little bit of haze in the horizon. So we're not ready to just buy the building at a 4.5 cap or 5 cap like we were a year and a half ago. That's why we're seeing less transactions. Right now, just want to give you the quick math on how to calculate the cap rate. And if you need, it took me a few years to fully understand this concept. So if you need to really kind of dial in the cap rate, I've got a lot of videos on our YouTube station that go into cap rate, how to calculate it, what it really means. So I'm going quick on this, but this is just real round numbers so you can get an idea of how to calculate this. If, let's say, we buy a building and that building generates 100 grand of net operating income. Purchase price, let's say, is $1 million. Heck of a deal, by the way. The cap rate formula is NOI divided by purchase price. That's going to equal 10%. Real rough numbers. I haven't seen a 10% cap rate in many years, not even out of state. I'm seeing cap rates for apartment buildings across the country, really, United States, really between 5 and 6%. Bay Area have been sub 5% for quite some time, although I'm seeing some 5% happen, and have closed some 5% in, recently in the last, even when the market was rolling hot. And even in the Central Valley, Stockton, that area where transactions have really slowed down, the cap rates have not, though. There's not gone up. So you're not going to see a lot of 10%, but this is just rough numbers giving you an idea of how to calculate it. Now, quick thing to remember, the higher the better when you buy, the lower the better when you sell. It's the inverse of like stocks buy low, sell high. It is the same concept, but when we're talking cap rate, the higher the better when you buy, meaning that you're buying where that building's generating a higher return. Investors in the marketplace are saying, hey, we need more return in order to buy these buildings. When you sell, you want to time it up to when investors are willing to take less of a return because it's so competitive, or maybe because interest rates are so low like they are now. So when you sell, if you're thinking of doing that and you're thinking of timing wise, you want to time that up when the marketplace is trading cap rates at a lower rate. When the marketplace is trading up to 10 is when you should be buying. When they're trading down to 5 is when you should be selling. All things considered, we got different considerations of when you sell, but we're talking about market timing, so I want to drill that in. This is why we spend time on a cash flow model, because if you don't understand this and you go to timing, then you just, you're playing craps, at Vegas type of thing. And we don't want to do that in investing. So we take risks as entrepreneurs, investors. You don't take risks. Trying to say here is let's take some calculated risks to help you make better decisions. All right. Now, other terms, I'll go through them quick. Net cash flow is simply the cash remaining after all expenses are paid and the mortgage is paid. This, if you have a mortgage payment, you take your NOI, you pay your mortgage, that we call debt service, and you get your net cash flow. Now, to evaluate that number to see is that a good deal or not, you take your net cash flow divided by the total cash invested. Side note, total cash invested is the down payment plus closing costs. How many of you guys have been to the closing table thinking, hey, I'm putting down, or my client is putting down X amount, only to find out that X amount is just the down payment. It's going to be some closing costs. transfer taxes, loan points and fees, escrow charges, etc. So these are things you have that equal your total cash invested. So to figure out if that's a good deal or not, you take that net cash flow divided by that total cash invested, and that's going to give you a rate of return, which is our cash on cash return measure. Internal rate of return, I won't spend too much time on that because that's more of an institutional measure, what the big companies use, because they have a lot of cash and they're more so concerned with the growth of that cash than the annual cash flows. But the internal rate of return is the total return. I say total return, that includes cash flow, principal pay down. Every time you make a mortgage payment, you pay the principal pay down, appreciation or depreciation of a property, and the tax benefit or liability. All of that gets calculated into the internal rate of return, and that must be done over a period of time. So in order to calculate the IRR, and that's the nickname for it, internal rate of return, you have to have a projected period of time that you're going to hold that property. A little bit more of an institutional measure, but a great way of looking at the bigger picture, because cash flow is the king, is the queen, but it's not the only way we make money in real estate investments. Principal pay down, appreciation, tax benefit, tax liability, all those things factor into the return, which is why we love real estate. Right now, a couple of quick calculations, and then we'll roll into this market timing piece. So remember, you want to be able to analyze your cash on cash return to see if this is a good deal. Don't get into this thing. And I see this from new investors, but I also see this from experienced people, especially people who are maybe doing exchanges or have pressure to buy something, is you want to make sure this cash on cash number is going to fit what you want. And I've got another video about developing your investment criteria, which goes into, hey, what is your end plan? What are you trying to get to? This whole real estate investing world, what are you trying to have that accomplished for you? Figure that out and then work your way backwards, right? Hey, I want to have 20 grand a month coming in by the time I'm 65, 70 years old. What is that going to take to get, what is it going to take to get you there from where you are today? And a big part of that is figuring out what do you need to make annually on your cash invested. That's your cash on cash return. Big important thing. All right. The formula, again, we take annual net cash flow and we divide it by initial investment, or total cash investment. All right. And in this example, let's say the building generates $15,000 a year of net cash flow. We divide that by our initial invested, the total cash invested of 100K, and that gets us 15%. Right now, you guys, market timing right now in the Bay Area, if you're getting anywhere between 5 and 7%, that's actually pretty good on apartment buildings, on commercial real estate. Now, if you're going out of state, let's say you live in the Bay Area, but you want to buy out of state, then you best be getting a higher cash on cash return than you would get in the Bay Area, or else why would you do all that extra work? Very important, right? This is not rocket science, but it is something that you could apply. Give you an example. If you're going to buy a building and you live in Oakland versus if you're going to buy a building in Stockton, well, if you're going to buy a building in Stockton about an hour from here, generally you want to make sure that net cash flow, the cash on cash return on that building is going to beat what you can buy in Oakland, or else why make the trip, all right? So just keep that in mind, and these returns are going to range. Bottom line though, here's the deal. You want your cash on cash return to be higher than your cap rate. That's an important piece right there, because that means you have positive leverage, meaning that the loan you have, you're making money on the bank's money. What you don't want to have is negative leverage, a cash on cash return that is less than the cap rate. That means that you are losing money on the bank's money. You can do that in the short term on some situations, but just not a really good formula for success, right? Especially long term. That's cash on cash return and how we calculate. Now, key measure of return that often gets overlooked is the return on equity. And this is the return on your property's equity, not the cash invested, okay? A lot of times we just look at the cash invested. We invested this cash, it's making us so much money. But we're trying to figure out how to time up the market. We're trying to figure out investment decisions. We need to look at our property's equity. All right, and the formula for that, of figuring out return on equity, is you take the property's annual net cash flow divided by the property's net equity. And that net equity simply is the value of the property minus all the mortgage and liens that are against it, and the cost of sale. Because if you were to realize that equity, you're gonna have to sell a property anywhere from 5 to 6% on commissions and transfer tax. When you figure that out, that's your property's net equity. So example one, you take the same property that we're looking at. So let's just say on the previous page here, we bought the property, put 100K down, we're making 15% of my money. Excellent. That property must be in the Midwest somewhere, you say. But whatever, you bought the property. Now, a couple of years later, property's still making that same 15,000. You're happy. And your 100 grand of cash turned into $300,000 of equity. That's a nice pop, right? It grew 3 times. Now, when we figure out your ROE, return on equity, you take your net cash flow divided by your net equity, and you see, hey, while I'm making 15% of my cash, I'm only making 5% on my equity, right? And now maybe you can start thinking about, well, if I were to sell this property and buy something else, maybe I can make more money, right? All right, and here's a rule of thumb. The ROE, return on equity, diminishes, gets lower as the property appreciates in value, all things considered, because you're getting more equity. That's great. In order for that not to diminish, your annual cash flow would have to be shooting up every year, which can happen, right? That's why this is generally, it diminishes as the property appreciates in value. Now, here's a quick example of what can be done, and then I'll go right into market timing, because when we're talking about timing the market, typically that has to do with people who've got property trying to make some decisions on when to sell, when to buy. It also has to do with people buying for the first time, but more likely it's figuring out what to do with what you have, property and cash flows. So when you look at the property's return on equity and you see some opportunities maybe to grow your cash flow, you might consider doing a 1031 exchange. Previous example, we saw that you invested that cash, you're making 15%. Then your equity, your property with value. So your equity, 100K in cash turned to 300,000 of equity. And now you're only making 5% on that money. Now, here's the deal. Market went up, so things are more competitive now. You can sell and do a 1031 exchange. Now, most of the people who do this, this is their primary problem with this, or this is the primary issue they have when doing an exchange is, hey, I could sell now, make a bunch of money, but when am I going to buy? Right? Everything's expensive right now. It's competitive. When I do an exchange, there's a timing element of it. And you're right. You need to have a team that you're working with, and you need to have a plan. And I've got a couple videos on my YouTube station where we talk about 1031 exchange success and what are some of the keys you need to be focused on doing a successful exchange, on finding your replacement property, because you want to spend time on it. All right. However, when you do it, if you do it right, it can be a really, really good wealth accelerator. Because let's say in this example, we said, okay, let's do an exchange. Now, the marketplace is way more competitive than it was when we bought up here. We put 100K down here, got this 15%. So maybe you're not going to get 15% cash on cash, right? Right? Like we just said, you're going to get 5 to 7% right now if you're doing good in the bank. But you got more equity, more cash to play with now because your property grew in value. So let's just say you took that 300,000 that you achieved from the sale, did a tax deferred exchange, and now you're only able to make 10% on that money and not 15. And like I said, it might be even less than that. But just say all things considered, you're making 10, but you're making 10% on a bigger number. Kind of that compounding effect, guys. So now that is $30,000, right? Now you doubled your cash flow in one move. And you might say, well, look, you just said it, you can only get 5 to 7% cash on cash. Well, that's typical in the Bay Area. Say you sold your property in the Bay Area and you went to Stockton, where you could get you can get these 10% cash on cash numbers. Or you sold and you went to Texas, where you can get these cash on cash numbers, or some other place, which, by the way, a lot of people are doing, and they are doubling their cash flow, especially because they have a lot of equity in their Bay Area properties. This is a really, really good plan of attack, and something that you all can look at doing. And then that rolls directly into the next piece of what we're going to talk about is timing the real estate market, because the real estate market runs in cycles, it runs in peaks and troughs, valleys, all of that. It's not one, it just always goes up in value, as you should know, right? Anybody who went through the Great Recession should know that. Here's the deal, though. We're in an interesting period of time where we have a lot of, I won't say manipulation, but you have a lot of monetary policy affecting what's going on, meaning that they have pushed so much capital, the government has pushed so much capital into our system before the pandemic, during the pandemic, and now, that it's really skewing how things work. Because here in the book, Time in the Real Estate Market, he talks about these 7 major trends that are impacting the real estate cycle, right? The first 3 kind of operate at a national level. They affect everybody. So inflation, interest rates, flow of funds in the real estate. Interestingly enough, we have not, when I say we have not, in the 2000s beyond era, we have not really seen significant amounts of inflation. A lot of people, and I'm not an economist, I'm not going there, but just from a layman's standpoint and looking at a lot of economic reports, we have not seen a lot of inflation that we expected to see coming out of the Great Recession. Because of all the money that was put in the multiple stimulus packages then, a lot of people were afraid, hey, it's only a matter of time. We are going to see heavy inflation hit our nation. And it really hasn't transpired yet, I would say. Now we have pumped even more money into the system at a record rate. Obviously, who could have, anticipated the pandemic? And a lot of this money was needed to keep things rolling. But the bottom line is, again, people are concerned with possible inflation. And inflation is a double-edged sword in the real estate world. One way means your prices are going to go up, and if you have a loan, your cost of that loan typically, or if you have a fixed mortgage, will stay fixed. And so there's some real benefit from that. But the problem when everything goes up in price is that, people start getting laid off because companies can't afford all the costs. People start having to make decisions of, okay, am I buying, what kind of apartment or house am I getting? Because I have to buy milk and eggs and all of the gas is outrageous. So it is a double-edged sword, and it can help you. The real estate inflation can help the real estate investor over time. But we've seen in periods of time where there's major inflation, it's actually been bad for the real estate market in the sense of creating a lot of job problems and economic problems that flow directly into real estate. So over time it can help, but if we get in an economic situation, we get a lot of inflation in a short period of time, it ain't good. Because you're gonna see a lot more people getting laid off, a lot more people not being able to pay rents, not being able to pay mortgage. Right? Now, interest rates and flow of funds into real estate. This is what is keeping real estate going now. It's what, after the dot-com boom and bust, it was what the low interest rate policy is what, created a big run up in real estate values. All right. When the market crashed in 2008, then interest rates had to come back down. And it was a couple years before the flow of funds, or mortgage money made it back in, and investment capital made it back into real estate. But now, during this pandemic, interest rates are at historic lows, and a lot of funds have been put into the real estate market. Now, there's different segments of the real estate market. Single family homes are going gangbusters pretty much across the country, particularly here in the Bay Area. A big part of that is because these interest rates are really, really low, and these mortgage companies, banks, lenders, they got a lot of money to lend, particularly in real estate. However, commercial real estate, interest rates are really low. The funds are there, but the lenders are really, really scrutinizing everything. But what's different now than what was happening in the Great Recession is there was not, for a couple of years from like 2008 to 12, there was not a lot of flow of capital into real estate. There was, but not in a major way. The money that was coming to real estate was people, buying up distressed properties in a major companies, funds, individuals with a lot of cash. But it took a while for the mortgage companies to really get back rolling full. In my opinion, for working the market, not until like 2012 did we really see lenders really come back into the market fully. Now they're in the market. They're there, but they're just evaluating their existing portfolios, and they're really being conservative, okay? These first 3 factors, inflation, interest rates, flow of funds in the real estate, these are national level, and I would venture to say global, right? Because we're in a global economy. These are kind of global issues, not even just national here in the United States. and interest rates across the globe are very, very low. Some areas see negative interest rates. Now, I'm not an economist. Somebody asked me a couple weeks ago, well, does negative interest rates mean that the bank will pay us on our loans? I said, well, look, I can pretty much assure that's not what that means. My understanding of negative interest rates, when you put money in the bank, it costs you. But banks are never going to give you a loan and then pay you. They don't work like that, you know? So will we see negative interest rates in the United States? I don't think so. Maybe, maybe not. But if it does, don't think, oh, that's a great thing because I can get a loan and not have to pay interest on it. That ain't what that means, you know? So just keep that in mind. That is happening in some parts of the world. I don't think we'll see negative interest rates in the United States anytime soon. Although there are people that's going to argue that we are going to see. You know, what I'm seeing is actually a slight uptick in interest rates here recently, but that the rates are still super low, man. And it makes sense for people to get mortgages, makes sense for people to refinance. And so that night there's a nice flow of funds into real estate right now, although it is a cautious, meticulous flow of funds. More so into the single family world, but also for the commercial real estate world. So that is what is hopeful. That is what is great about the current timing of the market right now. Now, some of the challenges, all right, have to do with the last four, which are the last four trends operate primarily on a local level. These are job growth, in or out migration of a certain area, path of progress, certain areas and neighborhoods, cities, and then new construction. So in the Bay Area, we've seen a huge out migration of people and companies, meaning that people are moving out, companies are moving out. I was on an economic update Heritage Bank hosted a few weeks ago, and the out the outlook wasn't grim, but it was just crazy to see the amount of companies and jobs that are leaving the Bay Area. At the same time, people leaving the Bay Area. It's, you know, people always move out. It's an expensive place, but it's happening at an alarming rate. Interestingly, house prices are still going up. However, a lot of times people just don't look at the bigger picture. They just see one thing, like house prices going up. Rental prices in San Francisco, in the interior Bay Area, San Francisco, San Jose, Oakland, have come down anywhere from 10 to 20%. San Francisco hit the hardest. And and that's, you know, people moving out. So at the same time, we've seen this boom in construction. So we've seen a lot of new construction properties hit the market in San Francisco, San Jose, Oakland, where at the same time where you got a bunch of people moving out. So you're seeing rents drop slightly in some areas, pretty significant in other areas, and then landlords fighting to get tenants in their building. You know, we haven't done that for a while, you know, not until like 09, 08, 09. And then after that, the rental market was gangbusters. But it's been a while since you've seen first month free or $99 deposit move-in specials. And that is starting to happen in certain areas. Not a huge concern, but that's what's happening. And again, I mentioned that earlier, is that I think that the rental amounts in places like San Francisco, so they just were just way outrageous. So in many ways, I think this is good just for the balance of the rental market. But that has to do with all these people moving out. And a lot of times I know a lot of people in the residential market like, oh, we're not affected. You know, our houses are going up. You know, people still have jobs. People can work from home, which is true. But at some point, this is a bit of a concern. Now, I think as we are opening up the economy, I think we'll start seeing less companies moving out of here. It was a really frustrating year for California, you know, not being able to operate, so many businesses not being able to operate and not being able to do what they typically do. And a lot of people are saying, hey, I just go to Texas, do what I need to do. I don't have state income taxes. I got more freedom, so on and so forth. I just think that you know, a lot of that people have thought out, but it really wasn't the plan. The pandemic affected that. So I do think that, you know, people moving out, companies moving out will slow down as we begin to open up our economy. And that'll help us make sure that we have a really solid recovery. You know, job growth is interesting because, and I say it's interesting, I think we still have a very diverse job market in the Bay Area. One thing is, this is me having my feet to the street, being an entrepreneur. A lot of companies are figuring out how to do more with less. So they figured out how to do more with more technology and less with human power. So human output, if you will. So they're figuring out how to do more with less. And so that may not be great for job growth, but on that same conversation, that might, for certain industries, there might be more job growth depending on what you're doing. So all I'm saying here is we got to watch it. You got to watch job growth in your market, and you got to watch in or out migration in your market. And you want to ideally be investing in places where there's going to be people and jobs migrating to. I'm a big proponent of Stockton, California. I probably said Stockton 2 or 3 times already. I see people and jobs moving out to Stockton. Amazon recently, in the last 2, 3 years, opened up a distribution center out there, and I believe they brought somewhere close to 3,000 jobs. That's a nice, significant pop in jobs for that area. And you're starting to slowly but surely see smaller companies moving out that way, which is going to mean more jobs moving out that way. There's already a lot of people moving out that way. So if you're looking to invest in the area, you're looking for somewhere where it has in migration, people moving towards that. Now, in particular neighborhoods, you're looking for the path of progress. You're looking for where is the city going to be investing money into. Talked about Stockton again. This city is doing a big infrastructure project downtown Stockton. They're putting all the electrical wires underground. And that to me signifies a path of progress. I think the city has a master plan of what they're doing, and they're going to be investing money into those areas that they want to set up for growth. And that's how you do it. You improve the infrastructure around that area before the growth comes. And then you'll start seeing new construction in that area. And so that's why you guys looking at these indicators will help you to make decisions, will help you to be wise with what you're doing, not just shooting from the hip, or not just waking up and saying, I'm out of California, I'm going somewhere I can do my business. If that's what you're going to do, let's take a methodical approach about how you're going to do it. What indicators are you looking at? And wherever you're going, make sure you're going somewhere where there's job growth, in migration, and you're investing in the path of progress where there will be some new construction at some point in time. Very, very important. I spent a lot of time on this slide, but it's probably the most important slide. So now I'm going to kind of go through some of the strategies. Now, you guys really check out this book, okay? He talks about a couple of different strategies on timing. And there's one that he talks about is the contrarian approach, which is counter-cyclical. All right, you're going against the cycle, or you're going against the status quo, if you will, going against what most people are doing. And it takes a lot of, I won't even say courage. It just takes a lot of understanding, I think, in order to be a successful here. Yes, courage too. And essentially is when you're buying when others are selling out of fear and desperation. So these are people who are buying properties in 08, 09, right? By 11 and 12, there were still some great deals out there, but we kind of already knew where the bottom of the market was in 08 and 09. Well, first in 08, when that October 08 happened, it was just mass. I remember at my real estate brokerage, from October 08 to the end of the year, I think there was 3 deals that got closed, and we were an office with close 60 to 70 agents. I closed a fourplex and a couple of them. There was like 2 or 3 deals that got closed in a quarter, right? Because everybody didn't know which way was up, and we did not know where the bottom was. And in fact, we knew that the bottom was falling. So when 09 came around is when I start seeing the contrarian investors, and there's one in particular who's one of the more successful apartment owners in the Bay Area. He started snapping up buildings in 2009 like you wouldn't believe, when no one else, and even lenders, were very, very concerned about the bottom. He was confident. And I'm gonna tell you why he was confident. Because the cash flow model, he was able to look at properties and say, hey, even if the market goes down a little bit, I'm buying at price points where I'm going to make a ton of money on the rental income. And having been around the block before, he also said, well, look, this is the time to buy. When, he had stopped buying in 07 because it was just too crazy to try to buy. And when he saw prices drop half of what they were, he's like, and the rental regardless of what the market was going to do, the numbers, cash flow model we just talked about, made outrageous money and outrageous sense. So that's what he was moving on. And you could do the same thing. You just, again, you have to have a good understanding of what's going on, and you got to have a lot of courage. But you're buying before the real estate market begins to improve. That's the contrarian approach, counter-cyclical. All right. Now, the momentum strategy, which is what most people want to do. So this is where, you know, you're buying once it is clear that the real estate market is starting to recover from the low point. So therefore, the bottom has been established. You're buying on momentum. This is where most folk, this is the folk buying in 2011 and 12 and beyond, because the things started to be, you know, you can clearly see it, right? And this is more prevalent, the more prevalent approach when there is some sort of market, you know, shakedown or low point. People generally, the majority of them, even investors, will start buying once they see the momentum building, right? And it lets the market's upward momentum carry the price higher in combination with the improvements that you make in the property. So you really want to make sure that you're buying, you know, in this time. It is not when things are beginning to roll. It's not time to say, oh, it's overpriced, I won't buy it. I know a bunch of people started to say that in 14 and 15. It's overpriced, it's going to drop again. And again, the cash flow model will help you be able to make those decisions, because you're looking at, first and foremost, is the property cash flow. And if you can see that in the cash flows at a rate of return that matches with your plan, it makes sense to buy. You know, you just want to, you know, time it appropriate. You're not going to get super steals all the time. You know, hitting single, double, and triple, that's still getting on base, you know, and that still makes sense. You don't have to hit grand slams all the time. Right? You still can make a lot of money though, and people have made a lot of money buying in this momentum period. And like he says in the book, the strategy can be used to any real estate class, houses, apartments, office, whatever. All right. Here's what he says though: be prepared to sell quickly before the down cycle. Now, I'll talk a little bit about selling. If you're in and out, some people, and actually, this makes a lot of sense. Some people say, I'm buying this property for life. I buy a property, I'm not going to sell it. This is something I want to have in the family. You know, if you've made a decision and you feel that strongly about the building, then you're not really thinking of selling. Most investors are buying and selling. And so you want to be thinking about, when you sell, do it before the down cycle, which you're really not going to know for sure. And a lot of people try to wait till it's the tip top. And the mistake there is that you're going to miss it half the time, because nobody really knows where the top of the market is until after we've passed it. And you don't want to be finding it out after you pass it. It's not the end of the world, but better to sell it before it peaks out, and you can get top dollar, you can sell quickly, and you cover your downside risk. Now, on that point, we're talking about selling. You want to sell during the upward cycle, right? And not, like we just mentioned, not trying to be greedy and wait till the prices top out. That's really, really important. And now let me say this, because my opinion, that top out of prices in commercial real estate was more around the 2019, into 2019, and maybe beginning of 2020 before the pandemic, because things was rolling. And that was kind of the top, depending on where you are, right? And for certainly in the Bay Area. Then pandemic happened, commercial real estate started. Houses, they're still going up, right? So you got to know your particular market. But if you're a disciplined investor, you want to sell before the top, just because you don't want to miss the top. You know, and I think greed and fear are two things that you don't want to operate from, but that the market operates from. And so when you want to operate from wisdom, knowledge, and strategy, but everything else is going on greed and fear. So don't be so greedy saying, hey, I'm gonna hold off to the absolute top. Figure out when that is. Now, if you have missed the top, happens, right? Might have happened commercial real estate world already, but you're still saying, hey, I gotta sell for whatever reason, right? And you could even look and still say, even with the missing the market, you could sell, do an exchange, and really improve your cash flow. That still can be done. So in that vein, you just don't want to say, hey, well, look, it started to go down. I want to wait for this thing to go up again. because a lot of times when it's down or it's flat, it will stay there for a while. And right now, what we have is we do not have a glut of inventory. 2008, 9, 10, we had this glut of inventory. And I think we do not have a glut. We just are beginning to see defaults. And I do not think banks are going to take them all back at the same time. If they do, if we do see a serious influx of defaults, it'll be timed out because or spaced out because the banks have learned, hey, we throw everything in foreclosure at the same time. That action in and of itself is going to drop prices down. Versus if we kind of space them out, that's been the whole model of this pandemic is that we're eviction moratorium, foreclosure moratorium, forbearance on mortgage. Let's just push the can down the line, if you will, and that way avoiding this major glut of properties. But the bottom line here is don't get too greedy when you're ready to sell. And when you're looking at cap rates, you want to be selling when the cap rates in the market are lower than when they are higher. Okay, all things considered. Sometimes you got to sell. You got to do what you got to do, right? But if we're sitting back and we're looking at this stuff, these are some really good things to help you make some really great decisions. All right. And another thing he says in this book, do not get carried away with your successes and forget the basics. And what he says is he's seen since the 60s and beyond multiple market swings. A lot of disciplined investors get away from their discipline because they're having so much success and they feel like they got the Midas touch. Everything you touch turns gold. Well, his advice from years of doing it and having been caught up in that very, problem itself is that, basically humility is an investor's best friend. Don't forget the basics of the game, that cash flow model that we're talking about, right? And even if you're focused on appreciation, long-term growth, do it based on these fundamentals of the cash flow model because, obviously the more income you make and if cap rates go lower, you're going to make more appreciation. If you invest in an area where you got positive job growth, you've got in-migration, you're in the path of progress, you set yourself up for more growth, but do it still with the fundamentals in mind. Like he said, don't believe your own press, what your spouse, your mom, your best friend, whatever they're saying about you on the internet. Stay disciplined, stay humble. All right. And what he's saying is, look, trend investing don't work forever. Good times do not last forever. Be careful to either get out in time or at least have your debt in comfortable shape. So we saying that. Say you want to hold forever or you miss time to market, you can get through a bad market if you have reasonable debt and that your cash flow to pay your debt. The people who wasn't able to make it through the downturn didn't have enough cash flow to cover the debts. So that's what he's saying here. All right. Very, very important. I hope this really helped you guys because like my goal in creating content, I know that a lot of my content is not going viral, right? But the goal of my content is to provide quality information to the marketplace, my ideal clientele, which is investors, seasoned investors, experienced investors, and starting out investors, that you can then take and put into actionable tasks in your business immediately. And that's my goal. And I think in doing that, that allows for long-term relationships, which in real estate is the name of the game. And for you guys that are listening, whatever stage of the business you're in, taking this content like this, and not just, okay, that's nice information, but taking that content, implementing it in your business, and constantly growing and improving. It never stops. It never ends. I said, you don't get to the mountain point and say, all right, I'm there. It's always going forward. So I want to get into a couple of the questions. I'll go to the chat. I see Elizabeth Circa asks, are you going to be sharing the PowerPoint with the attendees? Absolutely. I will be sharing this with you guys. We will email this back out. Also, this will be on YouTube shortly, the whole presentation in its entirety. We will make, Serta. Okay, this is Elizabeth Serta. I'm sorry. I'm sorry, I messed that up, Liz. Good to see you on there. And Michelle asks, what book is this? The book is called Timing the Real Estate Market by Craig Hall. Timing the Real Estate Market by Craig Hall. If you're an agent, if you're an investor, if you're a developer, somebody interested in the business, you need to get that book, read that book. It's very, very, it's a wealth of knowledge. It's a very, very big wealth of knowledge. Now, I know Allende had a question. I don't see his question in the chat. Let me try to see. Um, I'll stop my share here. See if I can go to the Q&A. Okay, no other questions there. All right, Chris Guzar says, new CRE agents, what are some key tips for setting up meetings with prospects? What's your approach? Hey, I love that kind of question. You know, if you know me, I love the sales process. I love sales. You know, and in this business, you know, well, in any business, selling is not telling, if you will. Selling is figuring out what people want and delivering it to them. So, to answer your question, what is the best, or what are some key tips for setting up meetings with prospects? All right, a couple different things is figuring out. And he says, I'm cold calling. Well, hey, let me just tell you this. In commercial real estate, cold calling, by the way, is an old school way, but it is one of the best ways to directly speak with the sellers and book appointments. I still cold call. I mean, I do a lot of content online. We do email marketing. We do postcards. We do, you know, advertisements. I still bang out the phone calls. Now, I have a team of 23 agents that I also teach and preach cold calling, warm calling, follow-up calling. But cold calling, about it, at the end of the day, in commercial, for sure, you got to do it because the competition is doing it and they're talking to your prospects. Now, one thing that we do a lot of this video content, and we'll put within our description of the video, we'll put a Calendly link for someone to book an appointment. But it takes time. If you just getting going, it takes time, honestly, to get people booking appointments like that. The best way is to do what you're doing, cold calls. Best way is to network. Also, network. There's all kind of ways you can network online at a million different commercial real estate meetings, investment groups, and you meet people. When you're networking, by the way, tip on networking, don't push to book appointments at the networking event. You simply are networking, you're making connections, and then what you do is you follow up. So then it becomes a follow-up call. We in our office, we determine we got cold calls and follow-up calls. And any follow-up call we define as you're following up with a lead that you met, a contact that you met. You're following up on someone who responded to one of your ads, your social media posts, your direct mail. That's a follow-up call. Or you're just giving a call to somebody in your networking, in your database, attempting to book an appointment. Those are still the best ways of getting appointments with particularly sellers and buyers. And you want to focus on the sellers. Buyers are gonna don't neglect buyers, but the more sellers you have, the more buyers you'll get, and the more stable your brokerage business will be. For you investors, same thing. Investors, you guys go through the same process a lot of times as we as brokers do. We're looking for deals. We're trying to find deals off market. Every deal that we as brokers bring to the market was off market before we brought it to the market, right? So you're doing the same thing. And by the way, I think, especially in commercial real estate, working with the broker and the agent who knows how to book appointments with people, knows how to prospect, knows how to cold call, knows how to hunt down deals, is one of the most consistent ways, investors, that you're going to find off-market deals. You know, unless you're full-time, full grind, pounding the pavement, cold calling, doing that, brokers are. So you want to have a couple of top brokers as part of your team that are going to get to it when it comes time to dialing for dollars, pounding the pavement, doing content, doing advertising, because we're always going to have a couple of deals that we are working on that are not yet on the market. So, Chris, I hope that helps, man. If you want to book a time to talk, let's talk some business and share more with you in terms of what we do, and let's connect. It's been real, you guys. We're going to end it up. It's right at 2:00. I like to stay punctual on these things. I know it's an hour, it's a long time in this microwave TikTok society that we are in. But you that stuck with us here live, and you that are going to watch this on YouTube, stand all the way to the end. I guarantee you got something out of this that you can then take into your business, particularly as it relates to timing the market. So I hope it's been helpful. Like, subscribe on the YouTube station, and stay tuned for our upcoming webinars. Thank you guys a lot. Have a fantastic day.